Fixed coupon notes. Hello and welcome to What is the Matter, where we discuss money matters. You know who what. Recently, Mr. What is the Matter has some friends who have invested into a financial instrument known as a fixed coupon note, proposed by some of their relationship managers. Today, I would like to go through what are these notes and why they are not suitable for everyone, in case you gong buy something that may not be suitable for you without realizing. On a serious note, please be aware that this video is for entertainment purposes only and does not aim to provide any form of advice. Okay. Fixed coupon notes. Fixed coupon notes, FCN, are sophisticated investment products that are a type of equity-linked structured note. FCNs provide regular coupon payments at predetermined observation dates, irrespective of the price fluctuations of the underlying equity. Why do investors buy FCNs? 1. Investors buy FCNs because they provide regular interest payments, offering a reliable source of income. The interest rates offered by FCNs may also be higher than what is offered in traditional fixed income instruments. 2. Incorporating FCNs into an investment portfolio mitigates overall risk exposure to individual assets or markets, promoting portfolio diversification. FCNs also provide a safeguard against downside risks, serving as a precautionary measure even in positive market conditions. 3. Should investors perceive the security as overvalued, they have the option to acquire FCNs and await the chance to purchase the security at a potentially discounted price in the event of a future drop in its value. 4. Investors can customize FCNs to align with their investment preferences, time frame, and objectives, adjusting parameters, underlying securities exposure, and risk tolerance accordingly. 5. Amidst heightened market volatility, FCN's economic terms become particularly attractive during such periods and can be appealing to investors. Who has access to FCNs? FCNs are generally more accessible to accredited investors compared to retail investors. This is because accredited investors are presumed to possess greater expertise, access to resources, and expert guidance, along with the financial capacity to manage complex investment products, albeit with fewer regulatory safeguards. To qualify as an accredited investor, one needs to possess minimum income of 300,000 Singaporean dollars in the last 12 months, or its equivalent in a foreign currency. At least 2 million Singaporean dollars of net personal assets, of which the net value of your primary place of residence can only contribute up to 1 million Singaporean dollars. How do FCNs work? An investor purchases a FCN for two company stocks, A and B. Let's assume the initial price of both stocks is $100. To go into details of the parameters of this FCN, a tenor of 6 months means the financial contract of this FCN will last for 6 months. The call frequency of monthly periodic means the FCN's performance will be reviewed every month and the investor will receive monthly coupons from the FCN. The knockout and strike level is set according to those numbers in the table. The performance of an FCN hinges on the underlying securities, leading to various potential scenarios when an investor opts to invest in one. In these scenarios, an investor can either receive his full principal with coupon payments or be contractually obligated to purchase the worst-performing security in the basket of underlying securities at a predetermined price in addition to the coupon payments. Let me first go through the FCN without a knock-in feature. What if, on the first observation date for the first month, Company A and B shares all close at or above $97, which is the knockout or call price of the FCN? In this case, early redemption, also known as knockout, KO, occurs. The investor will receive his initial investment at par, which means 100% of principal and the prorated first month coupon payment. However, on the first observation date, if a KO does not happen, the FCN will continue to the next observation date and eventually to the maturity date. Redemption at maturity depends on the performance of Company A and B shares compared to their strike price of $94. At maturity after 6 months, if the closing prices of Company A and B shares are at or above their strike prices of $94, the investor will receive 100% of their principal and all 6 months coupon payments. What if at maturity, Company B shares are trading at or above $94, while Company A shares are trading below $94? Company A will be the worst performing equity. In this case, the investor's principal will be converted into Company A's shares at the strike price of $94, but the investor will still receive all 6 months coupon payments. Another investor decided to purchase another FCN for 3 company stocks, X, Y, and Z. The parameters are largely similar to the earlier FCN, with the exception of a knock-in feature for this FCN. The knock-in level of this FCN is $92. Knock-in feature acts as a cushion to minimize an investor's level of risk exposure in a FCN. Firstly, if none of Company X, Y, or Z shares fall below the knock-in level of $92, the investor will receive 100% of their principal and all 6 months coupon payment. This is irrespective of whether Company X, Y, or Z share price falls below the strike price of $94. However, if on any knock-in observation period, the share price of the worst performing company, for instance, Company Z, goes below the knock-in level of $92, a knock-in event occurs. In this case, redemption on the maturity date depends on whether Company Z's shares close above or below its strike price of $94. At maturity, if Company Z's share price is above $94, the investor will receive 100% of their principal and all 6 months coupon payment. However, at maturity, if Company Z's share price is below $94, the investor's principal will be converted into Company Z's shares at the strike price of $94, but he will still receive all 6 months coupon payments. Risks of buying FCNs? 1. The performance of FCNs hinges on the underlying securities, particularly if it exhibits high implied volatility. Upon maturity, if one or more securities fall below their strike price, investors will be assigned the worst performing security in the basket at its strike price, resulting in an immediate capital loss compared to their initial principal. Moreover, if the security's price plummets to zero, investors holding shares at the strike price would lose their entire principal. This situation can be alleviated by having a long-term investment horizon and investing in securities with solid fundamentals. This enables the share price to eventually rebound and rise. By patiently waiting for the share prices to surpass the strike price, investors can then sell their shares at a profit. 2. Financial institutions issue FCNs, thereby exposing investors to the credit risk associated with the issuer. 3. Even if the price of any underlying securities consistently exceeds the strike levels, investors will not be able to capitalize on any capital appreciation gains, as they are restricted to the returns predetermined by the FCN. In summary, it is essential for investors to conduct their due diligence before committing to any investment decisions. Given that FCNs can be complex investment instruments, investors should carefully evaluate factors such as the selection of underlying securities, their potential performance, the creditworthiness of the FCN issuer, the calculation of returns, the risks associated with FCNs in volatile markets, and their willingness to invest capital until the maturity date. These considerations will help investors determine whether FCNs align with their investment objectives.